Welcome to today's Financial Insights segment. Hi, I am Deepnan Puriwal and you're watching the Savera. If you're thinking about investing in Indian initial public offerings or IPOs, you might be wondering if it's a good strategy for building wealth. The answer depends on your financial goals, risk tolerance, and how long you plan to stay invested. Let's dive into the pros, cons, and historical trends of investing in Indian IPOs so that you can make an informed decision. First, let's take a look at some of the potential benefits of investing in IPOs. For starters, IPOs often offer the chance for high initial gains. Some IPOs experience substantial price surges on their listing day, giving early investors the opportunity to make quick profits. But that's not all. A small subset of IPOs from fundamentally strong companies have turned into multi-baggers, offering long-term growth and substantial wealth over time. Another benefit is that IPOs are often launched during bullish market conditions, which can give early performance a nice boost. But of course, it's not all sunshine and rainbows. There are also significant risks involved. One of the key risks is underperformance. Studies and market data show that a significant portion of IPOs fail to outperform broader market indices like the Nifty 50 over the long term. In fact, research from the last 20 years reveals that more than 65% of Indian IPOs have underperformed the Nifty 50 index. Another challenge is volatility. IPOs can be subject to hype, leading to overvaluation at launch, and a correction can follow soon after. Plus, there's selection bias. While success stories are highly publicized, many IPOs fail to deliver and some even get delisted. Let's take a look at how Indian IPOs have performed over the past 2 decades. Research suggests that over 65% of Indian IPOs have underperformed the Nifty 50 index. A study from May 2022 found that 27% of companies were either delisted or merged, 38% of IPOs delivered negative returns, 18% provided returns comparable to fixed deposits, that is around 5 to 7% annually. Only 16% of IPOs turned into multi-baggers. Despite the general trend, some IPOs have achieved extraordinary returns. Take PI Industries for example, which saw a 6,48,500% return, or Bajaj Finance, which delivered a 1,33,600% return over 20 years. However, these are outliers. The performance of IPOs also varies with market cycles. For instance, during the 2002 to 2007 bull market, 11% of IPOs became multi-baggers, whereas the post-2008 period saw fewer standout performers. The short-term, IPOs often experience a surge in prices due to high investor enthusiasm and market hype. For instance, in 2021, IPOs like Zomato and Nykaa saw significant listing day gains, with Nykaa jumping 80% on the first day. However, Paytm experienced a 9% loss on debut, highlighting the risks. The story is, however, different over the long haul. According to research, after 1 year, 60% of IPOs traded below their issue price. After 3 years, only about 35% outperformed the Nifty 50. And long-term success depends on the company's fundamentals, their market conditions, and sector growth. To back up our points, here are some insights from studies and research on Indian IPOs. Sehgal and Sinha 2013 case. Their study on IPOs from 1992 to 2006 found that the average listing day return was 17.4%, reflecting significant underpricing, but returns varied widely. The Chittorgarh.com 2021 boom. Analysis from Chittorgarh.com shows that in 2021, IPOs like Zomato, Nykaa and Paytm delivered short-term gains, but Paytm notably underperformed. PwC India IPO Report 2019. Now, this report found that 35% of IPOs from 2009 to 2018 outperformed the Nifty 50 after 3 years, with sectors like consumer goods and financial services showing better returns. Here's the Prime database analysis from 2004 to 2022. Over 435 IPOs, 27% were delisted, but 16% turned into multi-baggers. Now let's talk about the key takeaways. In the short term, IPOs often offer listing day gains, but these aren't guaranteed. A strong market and high subscription levels can lead to positive returns, but there's always the risk of significant losses, as seen with Paytm. In the long term, the majority of IPOs tend to underperform market indices over the long term. However, a select few can guarantee exceptional returns like Bajaj Finance, which grew at a 50% compound annual growth rate over 20 years. Given the high risk and mixed performance of IPOs, relying solely on IPOs for growth could be dangerous. A diversified portfolio that includes established stocks or index funds can balance the risk and potential reward. To conclude, investing in Indian IPOs is a high-risk, high-reward strategy. While many IPOs underperform, a small fraction of strong performers can provide life-changing wealth. If you're willing to research deeply, understand market cycles, and stomach volatility, selective IPO investing could enhance your portfolio. However, for more consistent returns, looking at a broader market indices like the Nifty 50, which has delivered a 12 to 16% compound annual growth rate over 20 years, might be a safer bet. Stay informed with Savera and do like, subscribe, download the Savera app. Happy investing.